Investors are paying close attention to the slide in technology stocks and the volatility in the treasury markets. And joining us right now to talk more about that is Mohamed El-Erian. He is chief economic advisor at Allianz. He's also the president of Queen's College at Cambridge University and the co-author of the new book, Permacrisis, A Plan to Fix a Fractured World. Mohamed, let's just talk, first of all, about the economy, because we've got the GDP coming out in just about, less than an hour's time from now. That's expected to be a strong number, but there are so many questions swirling about the economy. Where do you think we stand right now?
Morning, Becky. I think the number is going to highlight two things. One is U.S. exceptionalism continues. Not only is it going to be more than double the rate of 2.1% for second quarter, but it outpaces all other advanced economies. The U.S. has been the growth engine for the world. It also highlights the challenges the Fed faces. But what we should not do is take this as a signal of the all clear for 2024. As you know, I've always pushed back on the notion that we would have a recession in 2023. I'm a little bit worried about 2024.
Early 2024, late 2024? How do you see this playing out?
It's hard to tell. I mean, we have first the rundown in savings. That's a big issue. Secondly, what's been happening in the interest rate market is really problematic. It's problematic for businesses. It's problematic for governments, for the Fed. It's problematic for households. And that is a significant headwind to economic activity.
OK, let's talk about the volatility we've seen in the Treasury market, because that's been dictating the stock market moves lately, too. Where do you think the direction is headed? What happens next in terms of the yields and why?
So we know two things for sure. One is that we've lost the anchors to that market. We've lost the economic anchor, we've lost the policy anchor, and we've lost the technical anchor. Second, when it comes to simple supply and demand, there's two things that are here and are going to stay here. The Fed being a net seller and the government issuing more debt. So the question mark, and you saw that in the auctions yesterday, is who's going to buy? And that question about buyers isn't going to go away anytime soon. You'll hear all sorts of images of catching a falling knife and things like that. And it is a problem because buyers are hesitant, and they should be hesitant in view of what's happening to the supply of government debt.
I'll give you a couple of points of pushback on that. First of all, people are reluctant to be buyers. Governments are reluctant to be buyers unless they look at the potential for conflict around the globe. Geopolitics may dominate and push them to a position where they say, we're looking for a safe haven. The U.S. Treasury is still going to be that, correct?
It should be that, but let me give you some numbers. Before the conflict started in the Middle East, the 10-year Treasury was at 480. Today it's at 497. And we still face the risk of escalation of that crisis. You know, there's been two big puzzles, and they speak to how unsettling the volatility in the U.S. Treasury has been. One is you haven't had it been the safe haven. We haven't seen the flight to quality and the flight to safety that you would expect, given what's happening in the world. The second thing that's equally counterintuitive is you have people talking about Bitcoins, about equity being the safe asset, because they've lost confidence in government bonds being the safe assets because of the nature of this interest rate risk. So yes, it should be the safe haven. It should have already benefited, but the reality is that the 10-year yield today is a good 17 basis points higher than it was before this latest conflict erupted.
Mohamed, if the Fed says it's going to keep rates higher for longer, and I believe them if they think that inflation is still a problem, that they will not lower rates. But if push comes to shove and there's nobody else buying treasuries, I dispute your first point, your first given, which is that the Fed is going to be a seller of treasuries. I just think if push comes to shove, they would be more likely to stop selling treasuries than they would be to lower rates.
That's a possibility. The question mark will be, do we have both economic weakening and do we have some sort of scare about a market accident? If we have those two things, then rates will come down. Look, messing around with QT is not that simple. What the Fed has wanted, what the ECB wants, what all central banks want is that the reduction in balance sheet be like watching paint dry. Predictable, gradual, nothing to see there. That's what they want.
Yeah, they want that, but they also want markets to not react in a horrible upheaval. And I don't know which one would win out if those issues all came to a head.
So we have a press conference next week. That would be a great question to ask Steve, okay, as to how flexible is the approach to QT right now.
Mohamed, your new book is Permacrisis, a plan to fix a fractured world. We've got 40 seconds left. How do you fix a fractured world?
You fix three things that are all fixable. I mean, this is a book that's full of hope. One is you alter the growth models to grow more inclusively and respectful of the planet. Two, you stop making these policy mistakes that we've made. And third, and perhaps most difficult, is to try to enhance cooperation, global cooperation, where there is a global challenge. These are feasible. There are engineering solutions for all three. We just need the political leadership.